Over the last 75 days, nearly 1 billion barrels of oil have vanished from the global supply chain. The Strait of Hormuz is effectively closed. While the headlines scream about World War III, we need to look at the numbers. This has evolved into a strict binary market event. The resolution of this crisis comes down to 2 days and 1 location, May 14th and 15th, inside the Great Hall of the People in Beijing, where President Donald Trump is sitting down with Chinese President Xi Jinping. This chart tracks the immediate consequence of the blockade. Brent crude has sustained a volatile spike above $105 a barrel for the duration of this 75-day window. That price level means retail investors must tune out the geopolitical noise. You need to position your portfolio for one of 2 extremes: a severe energy-driven recession or a massive market rally triggered by a peace deal. To understand those stakes, look at the physical bottleneck. This 75-day impasse at Hormuz has choked off roughly 20% of the world's daily oil consumption. This map shows the blockade cascading globally. Shipping lanes out of the Middle East halt, forcing massive fleets to reroute around Africa. That delay hits home instantly. Zooming into the Philippines, we track how rerouted ships translate into skyrocketing freight costs right here in Manila. Those elevated freight rates bleed into the local markets. The cost to move food, fuel, and basic goods jumps, which means shoppers are paying higher prices on the ground. Your everyday purchasing power in the Philippines is currently dictated by a geopolitical standoff 4,000 miles away. Initially, the U.S. responded with force. President Trump launched Operation Project Freedom, deploying naval destroyers to physically escort merchant ships and force the strait back open. But almost immediately, that operation was paused. The U.S. administration pulled back to give China the diplomatic leverage it needs to negotiate directly with Iran. Traditional international institutions, like the United Nations, have spent these 75 days paralyzed, unable to enforce a resolution or secure a ceasefire. In response to that paralysis, the U.S. is pushing an alternative framework. They are standing up a new Board of Peace designed to bypass the UN and handle regional stabilization through a select coalition of countries. Under the umbrella of this new board, Trump and Xi are hashing out a highly specific 14-point memorandum of understanding, an agreement crafted with the sole purpose of reopening the strait. China has every reason to sign this MOU. They need to secure their own energy imports, and brokering the deal gives Beijing direct influence over the world's most consequential energy corridor. All the naval deployments and political rhetoric are essentially theater. The only variable that actually dictates where the market goes next is whether ink hits the paper on that 14-point MOU. That means we stop analyzing geopolitics and start executing trading strategy. We have to treat this Beijing summit as a strict binary outcome. Scenario A is that the talks fail. Both sides walk away without a deal. If that happens, oil prices will surge toward $150 a barrel, and corporate profit margins will be crushed by the resulting energy costs. This sector chart outlines how to play that outcome. You take a defensive position on the Philippine Stock Exchange by targeting local energy producers and dividend-heavy utilities, the sectors that benefit in green when logistics and retail drop in red. Scenario B is the exact opposite. The 14-point MOU is successfully signed, Project Freedom officially stands down, and commercial traffic resumes. The moment that news breaks, the geopolitical risk premium vanishes, and oil prices crash back down to the $70 range overnight. We stay on this chart, but the momentum completely inverts. Your aggressive portfolio targets airlines, logistics, and retail stocks, ripping upwards with immediate margin relief. You cannot afford to guess which way these leaders will lean. Ignore the emotional predictions, react only to the data on the tape, and make sure your portfolio is hedged for both